Okay, let's go ahead and tackle this reading on market efficiency. And here when we talk about market efficiency, what we're talking about is informational efficiency, and the idea is, or the controversy or discussion is, whether market prices include or impound available information. Now, we're going to have to define that a little more carefully as we go through, but this is actually a topic that has some baggage associated with it. People can be fairly passionate about talking about market efficiency, which is a little surprising. I like to think of it, I would get rid of those words if I could, and I would just say, how competitive are the markets? So if you've ever tried to generate positive alpha, what you know is the markets are very competitive, and the degree of competitiveness is essentially what drives efficiency. So we could probably come up with better words to describe this. But anyway, we're going to talk about it in terms of efficient markets. So what are efficient capital markets? So here, remember, we've talked before and we said there's operational efficiency. That's with how quickly and what the cost associated with facilitating transactions. That's not what we're talking about here, right? So that's, we're always going to have some degree of inefficiency because of transactions costs and that type of thing. What we mean here is informational efficiency. So when we look at the price of a security, how quickly does it react to a change in available information? Okay, so if we have assets that react very quickly to a change in information, then we would have a market that is very efficient. So prices, and then we need to think about what is information. Well, the way we're going to break this down is we're going to ask if prices are efficient with respect to a particular information set. And we're going to conclude that yes, with respect to this information, the prices are efficient if using that information, an investor can't earn a positive abnormal return on average, right? So you can always have dumb luck going on. But if we're efficient, then with using that same information, well, if everybody's looking at the same information, it's already impounded into price, and what you should earn is a normal return. But can you go out and say, well, this firm just announced that they're going to pay their dividend next week. That's new information. Can you trade on that, today or later today and earn some positive abnormal return? Well, if you can, then we're not efficient with respect to that information. All right. So is information impounded into the share price or price of the asset? And here we're going to think mostly about stocks. Does that happen quickly? So market value, this is what we can actually buy or sell a security at. And we need to contrast that with intrinsic value, which in some sense is the value that a rational investor would place on this with full knowledge of the characteristics, right? So if the markets aren't efficient, then market values are going to differ from intrinsic values in predictable ways, right? So if that happens, well, look, if we know that the intrinsic values are higher than market values and that's going to converge over time, well, then we ought to be able to build superior portfolios, right? So if markets are not efficient, then we ought to have these sort of predictable changes through time. Now, again, when we talk about efficiency, we're not saying that the market prices the asset correctly. What we're saying is that it is not biased. So there's not going to be any of this gradual change. It can be high or it can be low, and we can't tell which. Okay, so it's going to be an unbiased estimator of the intrinsic value rather than something that would be biased, which would lead to systematic changes through time. So the factors affecting the degree of market efficiency, that's going to be the number of participants in the market. So if you only have 3 people and 1,000 securities, well, that's going to be hard to make that market efficient. Okay, you have the availability of information. So the more information that's available, the more quickly it's available, the more efficient the markets are going to be. Impediments to trading, so you have really high transactions cost or you can't short or something like that. That's going to make the markets less efficient. You see this manifested in real estate. So the lament there is that you can't short real estate. You can short a REIT or something, but you can't short real estate. So the only people that get to express opinions in the real estate market are those that think real estate's going to go up in value. All the bears, they can't do anything because you can't short it, so that would be an impediment to trading, and that leads to potentially real estate bubbles, right? So, and then what are the transactions costs, information cost? Well, transactions, what does it cost to trade? How quickly can we trade? Those types of things are also going to impact the level of market efficiency. So Gene Fama, in a very, very long time ago, ago wrote an article about market efficiency where he specified 3 separate levels of information and then asked the question about, are the markets efficient with respect to these different levels? So the first one, which is known as weak form efficiency, says, well, is the market efficient with respect to market information? So market information you can think of as price and volume data. So, if you think back to technical traders in the 1970s, if we were thinking of market data, we could look at time and we could look at, stock price on this axis, and we'd see that, if we had something like this. Okay, well, this is the head and shoulders pattern, right? This was a bear signal, I think, and that meant that the stock was going to go down. Well, that's market data, right? That's data on prices through time. And then you could also put a volume chart underneath it, and if there was more volume, the signal was more reliable and that type of thing. All of that seems a little like silly talk to me, but nonetheless, that's what market information is. So price and volume data, can we use that to develop a trading strategy that is going to allow us to earn superior returns? Well, if we can, then the market is not weak form efficient. Okay? And if we can't use price and volume data to generate a trading strategy that's going to be more efficient, then the market is weak form efficient. That is, it is efficient with respect to market information. Now, the next level, called the semi-strong form, I've always wished Gene would come up with a better name than semi-strong, but I've tried and I couldn't come up with one myself, so I shouldn't criticize. That would take the market information and add to it public information. So public information is they've announced they're going to pay a dividend, they've given earnings guidance, they've announced they've got a new contract with the government, all those sort of things that you could read in real time today on electronic news, that sort of stuff. So what's excluded? This is basically everything other than inside information. So this market is semi-strong efficient if you can't take market information and public information and put together a trading strategy that would lead to superior returns. And finally, strong form efficiency. This is when we would add private information, and we're going to have there's been a bunch of tests of these different levels of efficiency, but we're pretty sure the markets are not efficient with respect to private information because the market hasn't been able to act on it, right? It's not yet impounded into prices because it's not yet known by market participants. So if you have private information and you're not opposed to the potential for spending some time in the Gray Bar Hotel, then the evidence is that you can generate superior returns by trading on inside information, although it would be a violation of the code of ethics that you've agreed to abide by as part of the member of CFAI and a CFAI candidate. So let's think about efficient markets for a moment. If the markets are efficient, does that mean you and I are out of a job? Okay? Well, no, there's still a need for portfolio managers, even in extraordinarily efficient markets. Why is that? Because somebody has to think about what risk and return objectives are, how we quantify those. Someone has to make sure and manage the diversification needs of the portfolio. Okay, we also have to think about asset allocation via the objectives of the portfolio. So how aggressive are we going to be? And tax minimization is always going to be an issue in the real world. So if the markets are 100% efficient, there's still a very high need for portfolio managers. If their markets are inefficient, it might be that there's less of a need because eventually the public's going to catch on and say, oh, that's just like going to Vegas. So anyway, market efficiency, if markets are efficient, portfolio managers still have a job, I think is what they're trying to assure you of. So market anomalies. So market anomalies are observed market inefficiencies or things that we at least think are inefficiencies. So we can have some sort of predictable outcome that would give us a risk-adjusted return if we properly exploited it. And we see those we think about them in 3 different veins: those that manifest themselves over time, those that we can see cross-sectionally, and then there's a few others that we can't put in the cross-sectional time series. So what would those be? Well, a time series anomaly would be calendar effects. So what we see is that, January has low returns, turn of the month, first of the month had higher returns, day of the week, Monday was low, Friday was high, something like that. Day before a holiday was low, all these different effects, generally very small. I saw one not too long ago about daylight savings time. So it showed that the day after daylight, or the Monday after daylight savings time changes, the market did worse, and they attributed it to the to traders being sleepy or something like that. So anyway, and it turns out that in hindsight, that was all driven by 2 observations out of a 40-year time series. But anyway, so what about overreaction? So overreaction means that if we have good news, we overreact, prices go up too much. Bad news, prices go down too much. This is where losers beat winners. So take the firms that are have joyful announcement, the CEO's all smiles, the stock jumps up. Okay, and then the one where the CEO is apologizing, the stock falls. Sell these, buy these, okay, and the overreaction hypothesis would give you a winning portfolio. The last great anomaly was momentum, and that's the idea that if you have this earnings surprise, then you keep having positive returns on an ongoing basis, and maybe there's some rationale behind that in terms of what's happening with the firm and what else that's signaling. But it's still hard to think of that as not being an anomaly. So what we would expect if the firm had a good news announcement, we're looking at time again against stock price. So they're coming along, and we're going to have some good news announced here, or positive earnings surprise is the one we really focus on. Well, we would expect the stock price to jump, right? So we would expect it to jump up, okay, and then it would come along up here. But instead, what we saw for a while was this. Okay, so over a period of a long time, it was like 30 days or something like that. If you had the positive earnings surprise here, you could wait a few days and then buy the stock and still earn abnormal returns over the ensuing several weeks. So this was, it certainly seemed like a market anomaly. Like most market anomalies, once they're observed, they last a little while and then go away. So it hasn't been something that has been value adding over the last few years. Okay, cross-sectional, the size effect, this is small caps versus large caps. So if we look at start today and look back over the last 30 or 40 years, we see that there was a small cap bias. That is, small caps outperformed large caps by more than what we would have expected given any sort of modeling that we would do. Now, if you just looked at the last 15 years, you wouldn't see that. But if you look at the last 30 or 40, you see it. Also value, so low PE, low market to book, high dividend yield stocks, all those would be ways of measuring low value, right? So those stocks that have been beaten up, okay, well, those have outperformed growth stocks. So this is the value versus growth debate. Now, if you use a Fama-French model, which you've been able to talk about elsewhere in the curriculum, then that explains this away, but it explains it away sort of by embedding it in the model without much reason for it. So the value anomaly has been fairly persistent, although again, the last 10 years it's been hard to spot. So what are the other anomalies out there? So we can look at this slow adjustment to earnings surprise. That's the basically what's going on with momentum. And then maybe the thing that has gone on the longest and seems to be the most resilient is this pricing with IPOs. So IPOs, they have initial overreaction. So what you're going to see if this is time zero, here's your issue price. Well, they tend to jump up for a little while, and then over the long run, they underperform. So IPO, initial overpricing or underpricing initially, so there's a big jump at the issuance, and then over the long run, over the next couple of years, they tend to underperform, and you would think that investors would catch on to that. So you don't want to buy up here. That's when they offer it to me. What you want to do is be able to buy it at the announcement, okay, hold it for a few days, get the bump, and then sell it because you don't want to be on the slide, right? So IPOs, that's been one of the more persistent anomalies that we've seen. So anomaly evidence, most of the time when we think we've identified an anomaly, it is a result of the methodology we used, how we calculated risk-adjusted returns, those types of things. Many anomalies aren't profitable, okay, when you bring in transactions cost, and brokerage commissions, bid-ask spread, that type of thing. So these things go away. So I've been surprised that even with the great reduction in transactions cost, we have a colleague, we've done some work on options things, and we're looking at this and we think, wow, that's really seems anomalous. And then we brought in what we thought were modest trading costs, and it's completely gone. So anyway, that has a bigger impact than you might think. Some strategies have ceased to work over time. I would say, if I were writing this, I would say most strategies, once identified, have gone away. So again, you got to go back 40 or 50 years to identify some of these. If you look over the last 15 or 20, you don't see them. Some strategies only worked for a specific period of time. I think that's sort of saying the same thing. And then portfolio management shouldn't be based on anomalies that have no economic basis. And what we're saying here is, well, if you can't understand why this trend is happening, then the trend is probably not something that you can rely on going forward. Now, there are times that maybe there is some evidence or some reason for there to be price reactions that would appear anomalous, and maybe you can embed that into your portfolio in a reasonable way. Okay, so that's our discussion of market efficiency. Generally, we see that markets, if you want a quick summary, for the most part, we think markets are weak form efficient. With respect to the semi-strong form, that's where most of the anomalous evidence comes in, but that again seems to dissipate over time, and of course the markets are not anywhere near strong form efficient. All right, so what about behavioral finance, right? So behavioral finance, remember this, when I was coming up as a pup, we would never talk about behavioral finance because everything was in the rational man paradigm. And when this first started to be something that people that think about this at a high level, high-level practitioners and the like, academics would start thinking about behavioral influences. I remember thinking, well, this is really interesting, but it's kind of intellectual pornography. It's titillating, but not something you'd want to read in good company. So anyway, so behavioral finance, though, this is the idea that individual investors behave in ways that are not rational. Okay? So rational here we're defining based on this rational man paradigm. We learn, we would adjust to this momentum thing, we would do it quickly, all that sort of stuff. And it's potentially because of these cognitive biases. So I read a good book, it was Stumbling on Happiness. It's not a self-help book. It's about how you process in your brain. And we're finished thinking, well, there's so many cognitive biases that they've identified. I don't know if I know anything at all. So anyway, so we got these cognitive biases, these irrationalities. Okay, well, that manifests itself in the decisions that individual investors make. So things like loss aversion. Our risk aversion is asymmetric. If you take somebody that has a substantial position in their portfolio, so it's not like you're at Vegas and with $100, and you say, okay, here's a 10% gain, that makes us happy. But a 10% loss makes us miserable. Okay, so in absolute value terms, the amount that we dislike losses is much greater than the amount that we like gains. So we are really loss averse. Okay, overconfidence. So investors overestimate their ability to value securities, and we do that consistently. It's like men are a gender unified by the fact that we all think we're in the top 10% of drivers, so we're all overconfident, right? The gambler's fallacy, this is one they put, recent results are, I'm on a hot streak, right? So this idea that recent results get more weight than long-term results, so when you're on a streak, you don't want to quit, that type of thing. Well, the fact that you won in one market doesn't necessarily going to mean that you're going to win on the next market or the next bet. So the gambler's fallacy. Okay, information cascades. This is the idea that you have uninformed investors who follow informed investors. So you get people that really do a lot of research. They do whatever they're going to do. That cascades down, and eventually somebody's just following that, and any benefit you could have achieved from it is probably already passed. So investor irrationality due to these cognitive biases does not mean that the rational investors can beat the market. So in other words, the fact that we have individually these biases and have irrational behavior with respect to our portfolios doesn't actually mean that prices are different from their rational level. And the reason for that is, all that's required to have assets priced correctly is to have a cohort of rational investors. So that means that you and I can do whatever we want, but we have all these pension fund managers and life insurance portfolio managers, all those types of people. They're going to be keeping the markets efficient. So the markets can be efficient even if the individual small investors exhibit this irrational behavior. So that's one way to conclude with this behavioral finance stuff. So think about what we're doing here. So behavioral finance. This is the idea that we can be irrational, and in fact, there's lots of evidence that we are. It probably doesn't impact market prices, at least not in a clearly identifiable way. The bottom line for the market efficiency stuff is that markets are very competitive. Are they 100% efficient? Well, certainly they're not. Then at some point in the curriculum, we're going to ask the question, not in level 1, and actually not level 2 either, but level 3, we're going to say, okay, well, if you think you can beat the market because it's not 100% efficient, how are you going to do that? And how are you going to prove to us that you did it after the fact? So we're going to come back to that idea of efficiency eventually. It's going to be important in in a number of drivers as we go through. But again, we're not saying that the market is 100% efficient. We're just saying it's very competitive. At least that's what the evidence would indicate.